If you've ever walked into a bank with a thick stack of cash from selling a vehicle, getting a gift from family, receiving an inheritance check, or simply transferring your own life savings from one account to another, there is a precise dollar figure that automatically sets off a mandatory government filing. The teller doesn't ask if it's okay. They don't warn you in advance. The form is sent straight to an agency inside the Treasury Department that the average person has never even heard mentioned. The scary part isn't the form itself. The truly frightening part is what almost everyone does the moment they learn about this rule, the knee-jerk reaction they have to protect themselves. That single choice can transform completely legitimate money into the target of a federal felony probe. Last year, the government confiscated cash from thousands of ordinary citizens whose funds were 100% legal. I'm going to make absolutely certain that never happens to you. Under a law passed in 1970 called the Bank Secrecy Act, every single bank, credit union, and savings institution in America must submit an official currency transaction report, known as a CTR, anytime a customer conducts a cash transaction over $10,000. That report is filed on FinCEN Form 104 and lands directly at the Financial Crimes Enforcement Network, FinCEN for short, an office inside the U.S. Treasury, not the IRS. The bank does all the work. You don't fill out paperwork, you don't sign anything, and in most cases, you never even realize it happened. The bank has 15 days to send it in electronically and must keep a copy for 5 years. This takes place literally millions of times every year. Millions. And for the overwhelming majority of those filings, nothing happens. No phone call, no visit from agents, no frozen accounts. A CTR is not an accusation of wrongdoing. It is not the start of an audit. It is not a black mark on your record. It is simply required paperwork, automatic and routine. But I need you to hear that loud and clear, because what comes next is where ordinary people ruin their own lives. The moment most folks first learn about the $10,000 trigger, they have the exact same thought. Okay, if $10,000 sets off a report, I'll just keep every deposit at $9,000 or less. Or they decide to spread the money out over several days or several branches. That specific behavior has its own legal name, structuring. And under Title 31, United States Code, Section 5324, structuring is a federal crime, not a civil penalty, not a slap on the wrist, an actual felony. It is against the law to arrange or help someone arrange transactions with a financial institution specifically to dodge the reporting requirement. You do not have to be hiding drug money. You do not have to be committing tax evasion. The cash itself can be completely clean, earned honestly, inherited legally, gifted freely, and if you intentionally split it up to stay under the $10,000 line, you have still broken federal law. The punishments are brutal. For structuring under $100,000 in a 12-month period, you can face up to 5 years in federal prison and a $250,000 fine. If the amount is over $100,000 or tied to any other crime, the maximum jumps to 10 years behind bars and $500,000 in fines. And in either case, the government can take the money itself through civil asset forfeiture. Let me be crystal clear, because this point saves people. In 1994, the Supreme Court said in Ratzlaff v. United States that prosecutors have to prove you knew 2 things. 1, that the reporting rule existed, and 2, that deliberately dodging it was illegal. That's a real protection. But once you've watched this video, you now know both things. If you then go split deposits to avoid the rule, the government will say you acted on purpose. Don't hand them that evidence on a silver platter. An IRS study found that 91% of all structuring seizures involved money that was completely legitimate. 91%. 9 out of every 10 people who lost their savings to structuring were not criminals. They were regular folks who thought they were being careful. Most people assume the CTR is the only report banks send. It isn't. There is a second, far scarier report called a Suspicious Activity Report, SAR for short. Unlike the CTR, a SAR has no dollar minimum, none. A bank can file one on a $500 deposit, a $200 withdrawal, anything that looks odd to them or their software. and the software is incredibly good at spotting exactly the patterns people think are clever. 9,000 on Tuesday, 8,500 on Thursday, 9,500 the following Monday. The algorithm doesn't see 3 normal deposits. It sees someone trying to fly under the radar and flags the account instantly. SARs are especially dangerous for seniors because you will never be told one has been filed. Federal law makes it a crime for any bank employee to tip you off. You could have a SAR on your record right now and have zero clue. CTRs are routine paperwork. SARs are targeted suspicion, and the difference between triggering one or the other usually comes down to one panic decision about how you handle your own money. The single best defense is to stop trying to outsmart the reporting system and instead make sure your documentation is bulletproof, because good records are your armor. Let me walk you through the 5 most common real-life situations where retirees accidentally cross the line. Situation 1, selling a vehicle privately. You list your car. Someone pays you $14,000 in cash. Totally legal, totally ordinary. The mistake? Depositing $7,000 today and $7,000 next week. That's textbook structuring. The safe play: walk in and deposit the entire $14,000 at once. Bring the signed bill of sale showing both names, the date, the price, and hand it to the teller if they ask where the cash came from. Say, "I just sold my car." CTR gets filed. Life goes on. Situation 2, cash gift from your children. Your kids hand you $15,000 to help with bills or celebrate a milestone. This is a gift. Zero tax to you, but someone told you to spread it across branches or keep each deposit under $10,000. Wrong move. That's structuring. In 2025, an individual can give another person up to $19,000 per year with no reporting at all, and even above that, the donor files the gift tax form, not you. Deposit the whole amount in one transaction. Have your child write a short gift letter, names, date, amount, and one line saying, "This is a true gift with no expectation of repayment." Keep it in a file. Done. Situation 3, moving your own money between accounts. Maybe you're consolidating after losing a spouse, chasing a higher interest rate, or just cleaning things up. I had a client, a 69-year-old retired teacher, newly widowed, who closed an old account containing $23,000 she had saved over decades. While grieving, she moved it in small chunks over several weeks because big transfers felt overwhelming. 6 weeks later, she received a letter. The bank's software saw repeated sub-$10,000 deposits and filed a SAR. She was eventually cleared, but the attorney fees and months of terror on top of fresh grief were completely avoidable. If you're moving your own savings, do it in one clean transfer. Keep statements from both accounts and the transfer receipt. No suspicious pattern, no problem. Situation 4, receiving an inheritance. A loved one passes and you receive $40,000 from the estate, sometimes in cash from a safe or safety deposit box. For 99.9% of Americans, there is no federal estate tax. The exemption is over $13 million. But if you deposit that cash in pieces over weeks, the bank doesn't see bereavement. It sees structuring. Deposit it all at once and keep a copy of the will or the executor's letter showing the source. That paperwork ends any question. Situation 5, Social Security back pay lump sum. If you delayed claiming benefits, you can receive up to 6 months of retroactive payments at once, easily over $10,000. A CTR will be filed automatically. That's normal. Some retirees see the big government deposit and panic, shuffling money into different accounts in smaller pieces. That panic can trigger a SAR even on Social Security funds. Leave it alone. SSA and your bank both have perfect records of the payment. No extra moves needed. You may remember the panic a few years ago about a supposed $600 reporting rule. That proposal was part of the 2021 Build Back Better plan to lower 1099K thresholds for apps like Venmo and PayPal. The bill died in the Senate, and the final Inflation Reduction Act of 2022 contained none of those changes. Cash deposits at banks are still governed by the original 1970 $10,000 CTR rule, unchanged. There is actually a new bipartisan bill introduced in October 2025 called the Streamline Act that would raise the CTR threshold to $30,000 and index it to inflation every 5 years. It hasn't passed yet, but the direction is clearly upward, not downward. At the counter, tellers are required to ask about large cash deposits. That's normal compliance. Answer calmly and briefly. Sold my car, gift from my daughter, moving my own savings. Hand over your documentation if you have it. Do not over-explain. And whatever you do, never say anything like, "I don't want this reported," or "Will this trigger something?" Those phrases can end up verbatim in a SAR narrative. If the teller offers to split the deposit for you, politely decline, always. If you ever receive any letter or call from FinCEN, IRS criminal investigation, or the Department of Justice about your banking activity, stop talking immediately. Politely say, "I'd like to speak with my attorney first." That is your absolute right and the single smartest sentence you can utter. The report itself is not the crime. Trying to dodge the report is the crime. The $10,000 rule exists to catch money launderers and terrorists, not retirees cashing birthday checks from their kids. The system can't tell the difference unless you give it clean, complete records. Here's the 5-minute habit that protects you forever. Create one folder, physical or digital, called Large Cash Deposits. Every time you deposit more than a few $1,000s, drop 4 things in it. 1. A 1-sentence note of the source and date. 2. The supporting document, bill of sale, gift letter, etc. 3. The bank statement showing the deposit. 4. Any transfer receipt. That folder is your complete defense. You'll probably never need it, but if anyone ever asks about a deposit from years ago, you'll sleep like a baby knowing it exists. There is no senior citizen exemption, no good person exemption, no "I paid taxes my whole life" exemption. The law is the same for everyone, but the people with airtight records never lose sleep. I've watched too many honest, hard-working retirees get dragged through nightmares they never saw coming simply because no one explained the rules clearly ahead of time. That's why I made this video. If you know anyone who ever deals with large cash, parents, spouse, neighbor, friend, send them this link. 20 minutes today can spare them years of heartache tomorrow. Drop a comment below. Have you ever deposited over $10,000? What did the teller say? I read every single comment, and the most common stories become future videos. See you in the next one.